Welcome to episode 8 of the Podca podcast. I'm Jason Priebe.
I'm Austin Boniface, and with us today, a switch up from Mike, we have a special guest.
Mr. Dave Boniface, Austin's dad.
So, fun episode for you guys today. We can go ahead and get right into it. You want to go ahead and introduce the first topic?
Yeah, so today's episode, we're going to touch on a lot of things that are kind of going on in today's world and kind of front and center. And so one of the things we wanted to talk about is elections. There's a lot of conversation about elections. We just had the debate that just happened. And so I think it's important for us to kind of talk about, are elections important? How do they impact us here as advisors and for you guys as a client? What should you really be thinking about when we are in a big election year like this?
Yeah, it's really important. And luckily we have Dave here with us today, who his first election in markets was actually Andrew Jackson getting elected president.
Actually, it was Ronald Reagan, so it goes way back.
So out of all the elections that you've been involved with or been in markets for, how many of them spike controversy and market volatility?
Let's see, all of them.
And 2 years after that election, was the volatility warranted usually?
Well, typically, when we buy equities and we own stocks or bonds or whatever we're investing in, we're investing with the idea that we're buying a company and we're lending a company money. And frankly, so far, the elections just have not had that big of a long-term bearing on the valuations of the companies that we're buying.
Yeah, let's take a look at a couple examples I pulled just because, we got our United States election coming up, but we also had a surprise victory in Mexico, and India had a more narrow than expected election, which caused some volatility in those markets. Most of you guys listening to this probably didn't know that or didn't hear about that. It's, not very many people buy Mexican 10-year treasuries or pay attention to them. But 2016, when Donald Trump won the election, the Dow Jones fell 800 points, 4% overnight. 3 months after, the S&P was 6% higher. 6 months after, the market continued to climb, was 11% higher, and 1 year after, it was 19% higher. Also in 2016, we had the Brexit referendum, which caused an 8% drop in the UK stock market, only to see it up 10% 3 months after, 8% 6 months after, and about 20% 1 year after. So these elections, they cause scares, but they oftentimes mellow out and recover. So
do you guys know, or do you remember what the big scare was when Donald Trump won? Do you recall?
Honestly,
so the big scare was his rhetoric.
Completely forget.
His rhetoric was, we were basically going to completely stop trading with China. Mm-hmm. Every single thing trading with China, which would quickly mean a $30, $40 hammer, because we can't make hammers in this country anymore. The morning after he was elected, when he came out, he backed that rhetoric down almost immediately. And if you look, I believe the market's rebounded really, really dramatically. But it's just another situation where when we hear what these presidents are talking about and what they're claiming and what they're going to do, what they actually get done with their policy is typically a lot different than what their rhetoric is going into it.
And the fact that 2 out of 3 of us sitting here couldn't remember what it was that made the markets move is just another thing to remember. We're in tune to this stuff, and even we don't remember. A lot of this stuff is absolutely, it's just rhetoric and isn't going to come to fruition.
Yeah, and ultimately sticking to your plan and staying invested is the important piece of this, the message we want to get across. So let's pull up a chart here of what your growth of $10,000 is when only investing when your political party is in power.
Yeah, so staying out of politics here. But if you just want to invest when the Republicans are in control, or when it's a Democratic president, if you'd done that since 1932 and started with $10,000, in either scenario, you would have less than $1 million. Now, if you just let your money be invested the entire time and don't care about who's in office, you'd have more than $7 million. So at the end of the day, politics are interesting. It's a good conversation. It's probably a lot harder to have a conversation on politics than it was back in the days of Ronald Reagan. But really, the economy runs on its own.
Hating the government isn't a very good investment strategy. Stay invested and don't try to make your decisions based off of politics. Now, who's ever in office, both in Congress and the presidential election, does impact the economy, and policies do make a difference on what types of companies you should own. But going cash because you don't like Joe Biden or you don't like Donald Trump or you don't like whoever it is not a very good investment strategy.
But that is an interesting thing. You do have to consider policy. I would anticipate a Democratic win. You're going to continue to see agenda around green policies and moving away from fossil fuels. A Republican win, I would anticipate you're probably going to see a little more drive or a little more leniency on exploring and using some of our own natural resources. So tilting can sometimes be something you should consider. But to just say I want out of the market or in the market based on the current president or the current makeup of Congress is typically not the way to invest.
And Dave, what do you always say about your investment allocation decisions?
Remind me, Austin.
We want to be approximately right, not precisely wrong. You don't need to be right all the time. You just need to kind of be in the right area. You don't want to risk being 100% right and end up being 100% wrong and end up with less than $1 million in 70 years when you could have had 7 million. So making sure you're sizing your positions correctly.
We've seen more people wiped out simply because their conviction has been so high one way or the other. You always have to temper your convictions, because if you're wrong on a strong conviction, you're done. I mean, you basically could wipe your portfolio out. Just markets tend to be very, very efficient, for the most part, very, very efficient in their pricing. So you have to pay attention to that.
And, kind of moving past elections, I mean, look how efficient the market's been recently. Today, the day of recording it, we just broke the longest streak the S&P 500 has ever had without a 2% move. So we've just been kind of inching higher, maybe a half a step back, 2 half step forward. 1 full step forward, I guess. It's just been a boring market, up and to the right, slowly but surely.
And I believe volume's been light as well for the most part, other than a few stocks. Interestingly enough, though, it certainly seemed to be very concentrated. I know as we speak here today, I know we're seeing a little bit of some type of reversal away from growth towards value. That probably won't stick through the week, but it has been very, very concentrated in about 7 names.
Mm-hmm.
So longest streak without a 2% pullback in the S&P 500. What's the biggest reason for that? Why are we seeing less volatility now? I mean, I think when we started the year, we were still continuing to hear that we're going to have a pullback in the economy. Mm-hmm. Things are softening. Things aren't going to last, and things aren't going to be well. I mean, our media the last 18 months has been pretty negative. So what is it that's causing, one, the market to go the way it has since about October, but 2, the volatility is almost entirely gone too. What is it?
Is that 12 or below? Economy keeps chugging along, better than expected, but not all that much better, right? Definitely not worse. Inflation is coming down, but maybe not quite as fast as expected, right? I mean, we had 7 cuts priced in the beginning of the year. Now they're down to 1.
Early to mid-'90s, we went through a period we called the Goldilocks economy, where it wasn't too hot, it wasn't too cold, it was just right. And it kind of feels like that right now, where our inflation numbers are coming in as expected or potentially even a little calmer. At the same time, we're getting some okay growth across the economy and complacency. People just are feeling very, very comfortable, which of course is dangerous in and of itself.
One thing to remember in these times of low volatility and calmness is expect volatility to pick up, right? You think back to like 2017 where we had, the VIX, which is the volatility index, down towards 7, below 8. Well, that didn't end well. That did not end well at all. And I'm not expecting that to happen this time necessarily. But whenever you see straight up into the right boring markets for this long period of time, remember it doesn't last forever. And, you could see a 5% pullback. You could see a 10% pullback. Just remembering to stick with the course. And Jason, this, we've talked about this before. Good boring markets don't make up for your future spending needs. Don't increase your spending because you see your portfolio balance is up. This higher portfolio balance has to make up for the bad years, because there's going to be years that aren't 2% and boring.
Yeah. These good years are padding your portfolio so that when you do have a bad year, you've got room to take money as you always have been without suffering, big declines. That's exactly what this is for. Mm-hmm. Don't start spending more now, or you're really going to hurt yourself in the future.
Yeah. Last week, we talked about when you're doing your financial plan, clients of ours that work with us will know this, the Monte Carlo bands. We're probably above the 50 percentile trend line right now with how your portfolio is performing. That doesn't mean you can take a huge distribution and bring it back to the 50% trend line, because if you do that, you're borrowing from those years where it's going to be below, and it will be below.
And behaviorally, it's always really interesting to me, and sometimes we try to remind our clients that the markets are at the riskiest when volatility is low. They're at the riskiest when the market's putting in all-time highs. They're the least risky after we've collapsed 25 or 30%. It doesn't feel that way, obviously, when the world's coming apart. You turn on the television and they tell us why things are only going to get worse before they get better. Those are the times that you should be piling into risk, that risk is actually priced into the market. As we continue to hit new highs, you start to wonder if the appropriate amount of risk is priced in currently.
Dave with the groundbreaking quote, risk is highest when stocks are most expensive, and risk is lowest when stocks are cheapest.
Smart.
Common sense, but it doesn't feel like common sense.
Right? Behaviorally, you want to do the opposite, right? You lean into the expensive stuff and you sell the cheap stuff, right? But
about the only thing you can say when you're thinking about planning and not spending more is to look at what debt you have out there. Now is a good time where we're to really evaluate, do I have debt out there? Do I want to maintain that debt, or do I want to pay it off? Because we have had a good run in the market. I think those are the biggest things. Not spending more for other things, but spending to spend less in the future, right?
Exactly. That's a great comment. Dave and I were actually out before this. We were out at an enrollment meeting with some 401k participants, and there's a difference between good debt and bad debt too. Your mortgage at 2%, maybe don't pay taxes on an IRA distribution to pay that off because the market's up. Maybe keep that 2%, but that car loan or that pontoon loan at 7.8%, maybe a $20,000 extra distribution this year when the market's having such a good year isn't such a bad idea. And, then you can lower your future distributions by $600 a month or whatever that payment is.
Right.
Or even more so, what we saw earlier today was the number of people that had grown a fair amount of cash assets. And, if you have $150,000 or $200,000 sitting in a bank account earning 1% when you could be earning 4%, I mean, you're talking $500-$600 a month in lost interest rate opportunities. Just that's a lot. And while it doesn't seem like a lot, like the person we talked about today, I think it was like $200. You bring up that point that if you had $200 in your pocket, and then you went home and that $200 was missing, you'd rip your car seats out looking for it. So $200 a month is a lot of money.
Yeah, for sure.
$200 for no work.
No work.
I think that's a huge thing in the higher rate environment. People are still adjusting to that. If you're sitting with cash, make sure it's working for you. Don't let it sit there and do nothing. And don't think that the bank you have it at, where you're getting 1.5% or 2%, is doing you a favor. You're still missing on a pretty wide margin, and it takes no work. I mean, 20 minutes, 30 minutes, and boom, you can be getting 4 or 5% in current rates right now. So
and your bank's not doing you a favor by pointing your savings to a higher yielding account. Don't do your bank a favor and pay off your 3% mortgage faster than you need to. Your bank's turning around and lending that money at 7%. You're writing a bonus check to the bank manager when you're doing stuff like that. So, Yeah, and on the topic of interest rates, right into the next topic today. Wow, we went in from beginning of the year thinking we're going to have 7 25 basis point interest rate cuts this year. To now the market's pricing in one more by year end.
Nope.
Dave says no.
Dave says no. Dave says Jerome Powell wants to be a hero. And in my belief, he also doesn't want to appear political. So he cuts rates, he's going to look political. He raises rates, he's going to look political. He does nothing, he gets ignored. He doesn't want to be in the headlines. He doesn't want to blow this thing up. And in my opinion, we'll see if I'm right, unless something happens to break the economy that creates a need for liquidity, I think we're going to go the whole year without a rate hike.
Which, wouldn't you say, to break the economy at this point in the next 6 months within this year, it would have to be some sort of black swan unanticipated event?
Yes. Maybe something geopolitical, perhaps, maybe a failed currency, something like that would create a need for liquidity across the globe. I don't even, frankly, see much that could happen here domestically from an economic point of view. I mean, there's always political risk, but economic point of view.
We've seen unemployment start to tick up, and the Fed does have a dual mandate. It's stable prices and stable and low unemployment. They've pushed back on the employment rate ticking up being because of immigration. I agree. I do think that continues through the end of the year. Could see a cut in December or November after the elections, but it'd be December. I don't think there's a November meeting.
It'd be December, yeah.
Yes.
So I would say maybe.
If there's one, it's December. Otherwise, I agree. He's not going to want to. We saw this in the last election cycle, too. He didn't want to do anything. They pretty much froze until after the elections.
Yeah, and they have all the old adages. Fed follows the 2-year and all this stuff. Well, the 2-year is still at what, 5? It's hanging around 5.15. I don't expect don't expect rates to go back down to 3. Don't bank your retirement plan on mortgage rates falling back down to 3%. That might not happen anytime soon.
Well,
I believe right now, I think today or yesterday in the last couple of days, we now surpassed the longest inverted yield curve by a month, going all the way back since we've been inverting yield curves. And as I always like to say, the
inverted yield curve has predicted 11 of the last 9 recessions.
Yes.
It's also important to remember why them changing from 7 rate cuts expected to 1 or 0 is so important. It tells us everything. The economy is doing better than whatever the headlines say, right? You don't have to turn on the news and be like, oh my goodness, there's some layoffs somewhere, or there's a slowdown here. Just look at what the Fed is looking at. They have all the data. They add it together, and they're going, we don't need to cut rates to stimulate the economy. The economy is doing what we want it to do.
Yeah, we went from pricing in hikes in October of last year to those hikes turned into cuts, and the market just up and to the right. If you guys remember at the end of last year, we just had such a huge rally. Pricing in 7 rate cuts at one point, now down to 1. And even going from 7 rate cuts to 1 rate cut, you would think if pricing in 7 cuts did that to the equities, why are equities not lower? Why did equities not sell off? It's because the economy is growing. It's because people are still out there spending money. It's still stronger than it seems. I know a lot of clients we talk to, either they're feeling inflation and things are maybe starting to slow down, but you're still out spending money. What they said, money spent on cruises, like cruise liners, are all-time highs.
Yeah,
it is a tale of two economies, though. There's no question about it. The haves and the have-nots continue to separate each other further and further, and obviously that's that eventually will need to be solved.
Yes.
And topic for another day, because we could go on for a whole episode on this, but everybody has their own inflation rate.
Yes.
Not everyone has isn't feeling inflation the same way. So.
Right.
Next topic, kind of related to mortgage rates. So this is a CNBC article that came out. 36% of people see real estate as the best investment out there. What are your thoughts on that?
Primarily, it's a function of volatility, right? You don't see the volatility in your house. You bought a house 7 years ago and it doubled in price. Bought a stock 7 years ago, it likely doubled in price. If you saw the daily volatility and every time you drove by your house there was a for sale sign with the price, it might shock you a little bit on the value that your house probably changes $4,000 or $5,000 a day.
Electronic mailboxes.
Yes. Today my house
with a Zillow ticker on it that just updates everyone's price every single day when you go there.
Yes,
That's an idea for Zillow right there.
Yeah.
Yes, and of course also houses tend to be very tail oriented. Real estate can be tail oriented. When it drops 20%. It doesn't drop it can, but the headline grabbing thing, if you go back to the 1990s or the late 80s when rates ran, or 2007, it was brutal and quick.
Yeah, real estate tends to move in big movements, and usually, unless you're in the midst of selling your house, you don't really pay attention to it.
And time. You don't look at, like, kind of piggybacking off and not looking at your price every day. You let compound, right? You don't look at the price of your home, and you buy it 7 years later, you go to sell it, and you're like, holy crap, this thing grew at 3% per year compounded, but you feel like it grew at, whatever that is, 40%, and you think, wow, this is the best investment ever. Not to mention you're usually levered 5-to-1 with a mortgage. So, your mortgage doesn't adjust with your home price appreciation. Imagine if you could do that with NVIDIA.
How much better would it be if we didn't have to give our clients statements monthly, quarterly, heck, even annually? We just do every 5 years they get a statement on their portfolio.
It's interesting because
they miss all the volatility in the middle.
We see that with 401k. So our 401k business side, periodically, you'll have someone call in or pop up and go, "Oh my gosh, how did my balance get so large?" It's like, well, you haven't looked at it for 4 years, right? You totally ignored it, and then all of a sudden, what you thought was $20,000 is now worth $120,000 because of a combination of contributions, and just letting it compound and leaving it go. By all means, though, I don't think anybody on this table is anti-real estate, by the way, or urging you to sell your house and put it in the market by any stretch of the imagination.
No,
it's just a good reminder, right? Yeah. Don't freak out over volatility. Real estate has volatility too. It's just we're not putting up that price every day. And as a result, you don't have as much anxiety over it. So keep that in mind when you're thinking about your own investment portfolio too.
Right.
Less anxiety. Don't think about it. Don't look at that price every day. Don't look at that balance every day.
I think we should put that Zillow thing out in the mailboxes, and then we can all go buy, like, whoever makes Zantac or whatever the new anti-anxiety medicine is, and watch the anxiety kick up for everybody.
There you go. All right, we got an idea for Zillow, and then buy. No, I'm just kidding. Don't buy that stock.
No.
God. Interesting. Other thing in this article, though, it breaks down by annual household income, and real estate across the board is viewed as the best investment in the United States. But interesting to look at those lower class, saying savings. 20% of them view savings as the best investment, versus middle class only 15% and upper class only 7%. This isn't the breakdown of what they have in assets. This is what they view as the best long-term investment. So interesting to see, lower income people maybe a little discouraged with the economy. Goes back to that tale of two economies thing. And then gold as well, right? 23% of lower think gold is the best investment, 19% of middle class, and 14% of upper class. Your Armageddon hedge with your gold bars. Dave's a sock full of gold coins he keeps in the basement that he's going to beat me up with when I go to steal his clean water. It's interesting.
For sure.
3% in crypto for lower class.
Huh.
4% think bonds.
There's silver coins, and they're pre-1965 hillbilly silver.
Yeah. 25 cents a coin.
Worth 40 cents a coin now.
There you go.
Done well. So we have Dave here, and so I wanted to bring up this topic. Our firm, Magnetic North Advisors, custodies with LPL Financial. They're also a broker-dealer for us on the other side. But we utilize LPL to manage the accounts that hold our clients' assets. And I think it's really important to kind of bring that to light. They are a really great partner that we work with. And sometimes we don't really discuss our custodian and who we use and why we use them. And Dave has a long-time affiliation with LPL. And in fact, you are on their Ambassador Council right now. Tell us a little bit more about what Ambassador Council is.
So Ambassador Council is a group of, there's 60 across the whole firm, 24,000 financial advisors, I think.
Right. Group of 60 people, 60 selected to be a part of this Ambassador Council among 24,000.
Yep.
So that's
three groups of 20.
That's awesome.
So our group, which is the hybrid side, which all of you are clients of, Magnetic North, there's 20 of us, and we get together semi-annually, sometimes more often, but semi-annually at the LPL has a few different headquarters, but primary headquarters are in Fort Mill, South Carolina, and La Jolla, California. We get together at the corporate headquarters. We meet with senior management, and our goal is basically they lean on us to just learn what they can do to serve our clients better. That's the coolest thing about LPL. When you go to their headquarters, all over every wall is basically this mantra that, their goal in life is to help their clients treat their clients better, and we're their clients. So they're here to help us do a better job for you. That's their purpose. Some of they're always making changes, trying to stay on top of everything. But with $24,000 and $1.4 trillion in assets under management, it's a lot. It's a big legal. It's amazing to learn just how much stuff gets tied up within regulations and legal, and how they can get handcuffed from wanting to do a better job for all of us and all of you, simply because of the regulatory issues. But yeah, we lose sight of just how much they do for us. It's amazing.
It really is. I think the biggest thing that, I think you can look at other custodians and you can look around and we have, because that's part of what we need to do. And there's a lot of very similarities there, especially when it comes to, technology and what we need as backbone support. But I think the biggest thing that I continue to love, that we continue to love about LPL is really their people. It's that human capital. How, whether it's you or me or our staff that are working on your behalf or working on our client's behalf, it just feels like you're always talking to somebody who cares. Like you're talking to a friend, and you're working on a situation or trying to figure something out. And it's never just, I've never felt like I'm calling a 1-800 number. And that's really important for us and for our clients, because it means when things do come up and we want to get something done and we want to update a beneficiary that has a complex trust that it's going to, and we need to make sure it's getting approved and written right. We've got somebody there that's going to back us up and help us and make sure we get stuff done right.
Yeah, they're great. And another huge reason we like LPL, Dave, you can touch on this more, is the complex problem team, the high touch team for the complicated estates,
Right.
These complex trusts, the complex tax problems we have. LPL's got a staff of estate attorneys that deal with $1 billion estates, $500 million estates, and through LPL we can gain access to them for a $10 million estate or a $5 million estate. It's a huge advantage. And
at our fingertips, ready and waiting. They know us by name. We know them by name. Like, this isn't some huge, I'm going to Costco and I'm going to bulk buy stuff and we don't know who they are and they don't know who we are when we call. Like, our team is dedicated. We know them. They've done it. It's just almost speechless. They do a great job.
We've had their attorneys meet with some of our clients' attorneys before and, discuss concerns with a trust language or, opportunities. And they're just incredibly helpful. They don't charge extra for this. This is something that we're able to provide. They do have charge options, but we tend not to go that far. But
yeah. and business sales. When there's a transition, someone needs to structure a business sale correctly. We're going through a case right now where it's going to require, through business needs, about $8 million in life insurance. Being able to go through these incredibly sophisticated insurance people that know how, exactly how ILITs need to be structured. And we've had probably 2 or 3 cases where we've taken documents, run it through LPL, through our legal team at LPL, and they've said, you know what, this even though the attorney drew it up, this isn't exactly how it should read. You should be considering making these changes. And then going back to the attorney with LPL on the line, helping us kind of make sure that everything is done correctly for our state. It's just incredibly impressive, the work that they can do among the different departments.
On that insurance side too, I mean, directing us on which insurance company should we apply for, given the client being a pilot and the client flies experimental planes that he builds himself. Which insurance companies are going to underwrite him the best? I mean, we're all insurance licensed here, but this isn't something we do every day, and this isn't something that we're that hands-on. It really, we view them as an extension of our team, and they're very, very helpful.
To the point that most major life insurance companies, again, we don't do a lot of life insurance. We don't want to come across that way during a podcast, but most of the major life insurance companies actually have employees embedded within LPL. Mm-hmm. So it's kind of cool in this case. What was so impressive is running the underwriting. I was like, because of the pilot experience, it ran for a $4 million term and policy, ran from $11,000 to $74,000 a year, just depending on the underwriters. Being able to bring in the company's underwriter and tell us this is what it's going to cost, getting it pre-underwritten was just a dramatic competitive advantage.
Yeah, well, and it's great because you're on this council. We continue to be able to give them feedback and sculpt and be the architect of what the future looks like for us as advisors and how we interact with the back end that most of you really don't see other than to log into your custodial site to see your accounts. You don't realize the amount of help and service we're getting on the backside, and it's just something to think about.
An opportunity for listeners that are clients of ours. Feel free to give us feedback on your experiences with LPL as a custodian, right? Your experiences on statements. If you don't understand a statement, tell us. Let us explain it so you do understand it, first of all. Second of all, tell us how you would like to see it look so we can turn around and give that feedback to the decision makers at LPL. I think that goes a long way and helps a ton.
And reputationally, we're strong too. I think that helps a lot. Our own reputation with LPL, I think, goes a long way, in that we basically can reach out to almost any department head and say, hey, listen, you know what, our client's having a problem with this. Don't give me excuses. Just fix it.
Well, this has been great. Dave, I'm glad you're able to join us here. We're going to have you on more often. You have so much wisdom and insight from all the time you spent in the industry, and it's been awesome to have you on. And
if I just had the knowledge to go with it.
Oh.
But yeah. No, I've been doing this for a long time, and I actually love my business. It's like we always say, we get to talk to friends and solve puzzles. That's what we do for a living. So live it and breathe it.
Been living and breathing it for 36 years now?
36 years.
Wow.
He's seen a lot of clients go from starting to work on their financial plan at age 40 all the way to now being retired, and helping going from accumulation to decumulation to estate planning into life planning. It's a wealth of knowledge over there.
Yeah.
It's a big head, so he can fit a lot in there.
The apple doesn't fall far from the tree.
Yeah. Oh.
It's a big apple.
Big apple.
Well, on that note, thank you for joining us for episode 8 of the Podca podcast. Until next time.